the $100 threshold. Welcome back to our channel. This morning I watched something I've been tracking for 12 years finally break through the surface. Silver just crossed $100 per ounce, not 108 not 99s to 95, with some rounding error asterisk. $112 printed on the screen at 11:10 a.m. Eastern this morning, January 23rd, 2026. If you're watching the financial networks right now, you're hearing the word volatility about 40 times per segment. You're hearing retail mania. You're hearing comparisons to GameStop, to meme stocks, to every other irrational exuberant storyline they've recycled since the Dutch tulip era. Here's what you're not hearing. The vaults are empty. I've spent more than a decade analyzing physical commodities markets, building positions in silver when it traded in the 20s and 30s, watching the paper games play out month after month in the futures pits. I've seen manipulation. I've seen coordinated short attacks. I've seen delivery failures buried in the fine print of exchange notices. But what I'm looking at right now isn't a hyper-driven squeeze. It's a structural break in the global pricing system for physical silver. The mainstream media is staring at a chart on a screen. I'm watching the cargo ships. I'm watching the delivery notices. I'm watching the Shanghai Gold Exchange, where silver is trading at 111.67 right now, 11.55 higher than the spot price in New York. That $11 gap isn't market inefficiency. That's the sound of the Western pricing mechanism dying in real time. And what's unfolding on those cargo ships? What's showing up in those delivery notices? What's happening across physical markets in Asia? It changes everything about how this story ends, because the prices aren't rising because people are excited about silver. The price is rising because when you try to buy the physical metal and take delivery, it isn't there. Let me be extremely clear about what I'm watching unfold. This is not a rally. This is not a bull market surge. This is not retail investors piling into a hot trade. This is a physical run on the Western silver markets that has officially broken the paper pricing system. For 50 years, the price of silver has been set by contracts traded in New York and London. Futures, options, massive paper positions, representing far more silver than actually exists in deliverable form. The system worked because most contracts never converted into metal. People traded paper, settled in cash, and the physical market stayed quiet in the background. That system just died. What we're seeing now is a structural divorce between East and West. The Shanghai Gold Exchange is trading silver at a massive premium to COMEX. The LBMA is scrambling to explain why physical bars are disappearing from vaults. The delivery notices on COMEX this month are 5 times higher than last January. The paper price in New York is being overridden by physical demand in Shanghai. And the arbitrage opportunity this created is so huge that every ounce of silver that is already locked down is being vacuumed out of Western vaults and shipped east. The price discovery mechanism that governed silver for half a century no longer functions. The spot price on your screen is becoming less and less meaningful compared to what physical metal actually costs to acquire and move. We are watching one of the largest commodities dislocations of the modern era. The paper shorts, the bullion banks that have carried massive short exposure for decades, are staring at a $390 billion liability they cannot pay. Not in paper, not with cash settlement tricks, in actual physical metal. I'm going to show you the exact math of how arbitrage-driven backwardation created an unstoppable physical drain. I'm going to show you why the bullion banks are trapped with no clean exit. I'm going to show you the delivery data that proves this isn't speculation. It's already in motion. Let's pin down the snapshot of where we are. At 11:10 a.m. Eastern this morning, spot silver traded at $112 per ounce. That's a 3.29% move in a single day. Gold was at 496646. Now do the ratio math. Divide gold by silver, and you get 49.6.1. That number should make you stop and think. The historical average gold to silver ratio is somewhere around 80.1. For most of the last decade, it lived between 70 and 90. In March 2020, during the co-panic, it spiked to about 120.1. 49.6 isn't a drift amidst a collapse. It means silver is rising faster than gold, much faster. It means the market is repricing silver not as an industrial byproduct or a speculative toy, but as a monetary metal in shortage. But here's where it gets even more revealing, where the paper pricing system starts showing cracks. Pull up the Shanghai Gold Exchange right now. Look at the silver price there. 11,167. There's your 11.55 premium. In China, physical silver is trading roughly 11% higher than the spot price in New York. Sit with that for a full minute. If you can buy silver on COMEX at $100, take delivery, ship it to Shanghai, and sell it for $111, you've got an 11% profit on a transaction that takes maybe 2 weeks, 11%, risk-free arbitrage. That doesn't exist in functioning markets. In normal markets, arbitrage gaps get closed in minutes by desks with speed and scale. The fact that this gap has persisted for weeks tells you something is fundamentally broken. And what's broken is simple. There isn't enough physical silver in the West to close the gap. The metal is already gone. Look at the Shanghai Futures Exchange inventory. 581 metric tons left, about 18.6 million ounces. A few months ago, that number was over 1,000 tons. It's being drained in real time, and every ounce that leaves is being replaced by metal shipped out of London and New York. Now, let's talk delivery notices. I pulled COMEX data this morning. For January 2026, there are 826 contracts standing for delivery. Each contract represents 5,000 ounces. That's 44.13 million ounces of silver longs are demanding in physical form this month. 44 million ounces in 1 month. Bank of America has issued 233 delivery notices. JP Morgan has stopped 156. These aren't small players. These are the bullion banks that have steered this market for decades. And they're playing hot potato with metal they don't actually have sitting safely in vaults. COMEX has around 150 million ounces in total silver inventory. Only a fraction of that is registered, meaning it's truly available for delivery. If just 10% more contracts decide to stand for delivery instead of rolling forward or cash settling, registered inventory hits zero. Zero, as in the exchange, runs out of silver to deliver against futures. Now, here's the question. Everyone is dodging. Why doesn't COMEX just raise the price to match Shanghai? Why not let silver trade at 110s, $120, wherever it needs to go to balance supply and demand? Because that triggers the ultimate trap and the banks know it. Arbitrage-driven backwardation. Let me walk you through the mechanism driving this entire crisis. The arbitrage-driven backwardation. Once you understand it, everything else clicks. Here's the simple version. Backwardation is when the right now price is higher than the later price. In normal commodities markets, future delivery is higher than spot because you're paying storage, insurance, and carrying costs. That's contango. But in a physical shortage, the market flips. People will pay more for silver today than they'll pay for silver 6 months from now because they need it now. And they don't trust it will be available later. That's backwardation. Now add arbitrage and the trap snaps shut. Imagine two stores. Store A sells iPhones for $500. Store B across town buys iPhones for $700. What happens? Every iPhone in Store A gets bought within the hour and resold to Store B. Store A's shelves are empty by lunch. The only way to stop the drain is for Store A to raise prices to match Store B. But if Store A is locked into contracts to sell iPhones at $500, it's trapped. Either it breaks the contract or it goes bankrupt fulfilling it. That's COMEX right now. Store A is New York. Store B is Shanghai. The 113011 premium is the arbitrage opportunity, and physical silver is being vacuumed out of Western vaults to capture that spread. Here's why the banks are trapped. COMEX is built on paper. Most futures contracts never become physical deliveries. Traders roll positions, cash settle, or offset. The entire structure depends on one assumption. Only a small percentage of longs ever demand physical. But with an $1 arbitrage opportunity in Shanghai, everyone wants the metal. Contracts that used to roll are now standing for delivery. The paper game is turning into a physical settlement crisis. If COMEX raises prices to close the gap, say silver jumps to 115s in New York to match Shanghai, the short side of every contract takes a brutal hit. Banks with billions in short exposure get slammed with margin calls they can't meet. If COMEX keeps prices low to protect the shorts, the physical drain continues. The metal disappears. Eventually, the exchange runs out of deliverable silver, and the whole system snaps. There is no middle ground. This arbitrage has created a binary outcome. Either shorts get bankrupted by rising prices, or the exchange runs out of metal. The banks just realize they're shorting a market that no longer exists in paper form. Now let's translate that into dollars. The bullion banks, JP Morgan, Bank of America, HSBC, Scotia, have carried concentrated short positions in silver futures for years. We know this from CFTC positioning data. We know it from lawsuits and settlements. And we know it because it's been an open secret in commodities for more than a decade. The exact size of the short is impossible to know because it's spread across futures, options, swaps, and OTC derivatives. But we can estimate based on open interest and historical positioning. At $100 per ounce, the potential liability for the short side, if contracts demanded physical settlement, is roughly $390 billion to owners. $390 billion. That's not a position you casually unwind. That's not a hit you absorb with a couple quarters of earnings. That's existential for whoever is holding the wrong side. Now, compare that to physical availability. COMEX has about 150 million ounces in total inventory. At $100 per ounce, that's about $15 billion worth of silver. The entire COMEX vault system could cover less than 4% of the short side liability. LBMA has larger vaults, maybe around 1 billion ounces across storage facilities. That's about 100 billion at current prices. Still only 25% of the estimated short exposure. Here's the disconnect. There are 44 million ounces standing for delivery this month alone on COMEX. If that pace continues, and the Shanghai premium gives you no reason to expect it won't, you're looking at roughly 500 million ounces of delivery demand over the next year. 500 million ounces. COMEX doesn't have it, London doesn't have it, Shanghai is already being drained. So where does the metal come from? It doesn't. That's the answer. It doesn't exist in deliverable form. Now, let me show you another fracture line. The SLV ETF, the iShares Silver Trust, is supposed to track spot. It's supposed to hold physical metal and issue shares backed by that metal. This morning, SLV traded at 9071, while spot was at 112. That's a gap of more than $9, nearly 10%. Why? Because SLV is paper. It's a claim on silver, not silver itself. And as the physical shortage intensifies, the market is starting to price in the risk that paper claims don't get honored the way people assume. Think about what that implies. If the largest silver ETF in the world can't track the spot price within 10%, what does that say about the integrity of the paper market? It says the paper is failing, the tracking is breaking, the system built to let people trade silver without ever touching it is starting to collapse under the weight of real delivery demand. So let's recap where we are. Silver at $100 and $155 premium in China. Delivery notices running 5 times last year. A $390 billion short liability and maybe $15 billion in COMEX inventory to even pretend to cover it. The squeeze isn't coming. The squeeze is here. It's happening right now. And the only question is how the banks plan to get out. The vertical bubble argument. Let me borrow the skeptics for a second, because if I don't, they'll accuse me of being a permeable who ignores reality. Here's their case. Silver went from $31 to $100 in 12 months, a 220% move. Vertical parabolic. Every chart pattern says vertical moves end in waterfall crashes. This is a bubble driven by speculation and FOMO. And when it pops, everyone holding silver gets crushed. On the surface, it's a fair argument. Here's why it's wrong. Vertical moves in fiat currencies are bubbles. Vertical moves in tulips, dot stocks, and housing are leverage-driven manias. They implode because the underlying has no intrinsic anchor, or because supply can ramp to meet demand. But vertical moves in physical commodities during a shortage aren't bubbles. They're corrections. They're the market finally pricing reality after years of suppression. Think about it. For 50 years, silver traded in ranges that didn't make sense relative to industrial demand, monetary history, or scarcity. Price stayed low because paper markets created infinite supply through derivatives and contracts that rarely delivered. Now that paper mechanism is breaking. Price isn't set by how many contracts can be written in New York. It's set by how much physical metal exists and where it sits. This isn't hype. This isn't retail mania. This is the market correcting decades of artificial suppression. Here's another place skeptics get it wrong. They assume higher prices automatically bring more supply. They claim that at $100, mining companies will ramp production and flood the market. That's not how silver works. About 70% of silver production is a byproduct of copper, lead, and zinc mining. You don't just turn on silver output without increasing primary metal production. Even if you could, new mines take years: exploration, permitting, construction, environmental reviews. By the time meaningful new supply arrives, this phase of the crisis is already behind us. And here's the kicker. Industrial demand for silver is inelastic in the short term. Solar manufacturers can't just stop using silver because price rose. EV producers can't redesign electronics overnight. Silver is embedded inside supply chains that take years to reconfigure. So what happens when price spikes? Industrial users panic. They hoard. They lock supply contracts at almost any price because shutting down production is worse. Look at the solar industry right now. Panel manufacturing is freezing because companies are scrambling to secure silver at these levels. That's not retail hype. That's industrial panic. And it creates a feedback loop that pushes price even higher. The skeptics will call it a bubble right up until the day they're forced to admit it was a structural shortage the entire time. Now, let's talk about what comes next, because regulators and exchanges still have one last card to play. Rule changes. The CME group, which runs COMEX, already hiked margin requirements by 47% on January 7th. That's the cash you need to post to hold futures. When margins rise, leverage traders get squeezed. They post more cash or they liquidate. That 47% hike was meant to shake out weak hands. It didn't. Silver kept climbing and delivery notices kept coming. So now I'm watching for Margin Call Monday, the day they double margins again and force everyone on the long side to choose. Come up with twice the cash or sell. This is how they try to break squeezes. They change the rules mid-AM. They make holdings so expensive only the biggest players can remain. If you're a retail trader holding silver futures on margin, you're the target. They want you out so the banks can cover shorts without silver going to $150. Here's what I'm also hearing. And I want to be crystal clear. These are unverified rumors, not confirmed facts. There's talk of a force majeure declaration, a legal term meaning unforeseeable circumstances. In commodities markets, it's the nuclear option. The exchange says it can't deliver metal, so it cash settles contracts at a price it chooses. If that happens, longs get paid out at some arbitrary number, likely below current spot, and physical metal never changes hands. Shorts get rescued. The paper game continues. I've also heard whispers about secret swap lines from the Federal Reserve to bullion banks, emergency liquidity to keep firms like JP Morgan and Bank of America from collapsing under short exposure. Whenever a market moves against the establishment, the rules get adjusted to protect institutions. So here's what I'm watching. The Shanghai Gold Exchange Premium. If that $11 gap stays above $10, the physical drain continues. No matter what COMEX does, you can hike margins, you can declare force majeure, you can cash settle, but you can't stop metal from flowing to wherever it's valued most. The SGE premium is the truth. Everything else is noise. Now, let's talk media response. Over the next few weeks, you're going to see a coordinated narrative emerge. It'll fixate on volatility. It'll warn retail investors about dangerous speculation. It'll parade experts saying silver is in a bubble. What you won't see is coverage of physical premiums. You won't see delivery data. You won't see the Shanghai arbitrage. Why? Because if people understand what's really happening, the remaining metal in Western vaults disappears overnight. The institutional playbook is simple. Scare retail out while big money accumulates. Make the average person feel crazy for holding silver while banks quietly cover shorts at any price. Don't fall for it. Watch the data. Watch the delivery notices. Watch the Shanghai spread. If that spread stays wide, the game is still on. What this is not. Before I walk you through my personal battle plan, I need to make something absolutely clear. Something that matters more than any data point or price target. Nothing in this video is financial advice. Not one word, not one number, not one strategic observation. I'm not a financial advisor. I hold no licenses. I don't manage other people's money. I don't have clients. I analyze commodities markets for my own positions and share that work publicly because the information asymmetry in these markets is enormous and people deserve to see what's happening beneath the surface. But that does not make me qualified to tell you what to do with your money. When I talk about my plan, what I'm watching, how I'm positioned, those are descriptions of my actions based on my risk tolerance, my time horizon, my financial situation, and my conviction level. None of those factors are automatically yours. You may have different obligations. You may need liquidity next month. You may be trading with borrowed money. You may be investing for retirement 30 years from now. You may have a completely different thesis that contradicts mine. Those differences matter enormously when it comes to real investment decisions. So if I say I'm holding through volatility or I'm watching a trigger, I'm not telling you to do the same. I'm letting you see my thought process, how one person with 12 years of experience is navigating this environment. That's education. That's perspective. That's opening up a research process and a decision framework. It is not a recommendation. It is not a suggestion. It is not advice. Here's why this matters. The silver market right now is extraordinarily volatile. We're seeing 5%, 10%, 15% moves in a single session. Margins are shifting. Delivery dynamics are changing. Geopolitics matters. Industrial demand can swing. Central bank policy can change overnight. Any position in this market carries real risk. You could lose money. You could lose a lot. You could lose everything if you're leveraged and a margin call wipes you out. I can't know what risks you can afford. I can't know whether silver fits your portfolio strategy. I can't know whether you understand the differences between physical metal, ETFs, and futures. Those are questions you must answer yourself, ideally with a licensed professional who understands your full financial picture. My job here is to present data, explain mechanics, and share what I'm seeing in delivery notices, Shanghai premiums, and inventory drawdowns. Information mainstream media often ignores, but information isn't advice. Analysis isn't a recommendation. A thesis isn't a trading plan. You have to build your own plan around your circumstances. You decide whether silver belongs in your strategy at all. You decide what percentage makes sense. You decide if you can tolerate volatility, counterparty risk, and regulatory uncertainty. Those are your decisions, not mine. Here's another critical point. I could be wrong about all of this. The Shanghai premium could collapse tomorrow. Industrial demand could crater. The Fed could announce a massive swap line that rescues bullion banks and crushes price. A major discovery could change supply dynamics. Markets are complex, adaptive systems with thousands of variables I can't fully account for. My analysis is based on the best public data I can access and the patterns I have observed over 12 years. But that doesn't mean perfect insight or perfect foresight. I've been wrong before. I'll be wrong again. Anyone who claims certainty in markets is either lying or delusional. So when you hear me talk about $390 billion short liability or structural shortage or arbitrage-driven backwardation, understand these are frameworks, models, to make sense of complex data. But models are not reality. They simplify reality. They can help. They can be wrong. The map is not the territory. The thesis is not the outcome. The analysis is not a guarantee. This becomes even more important when we talk about geopolitical and regulatory risks. I mentioned force majeure, potential Fed intervention, margin hikes. Those are real tail risks that can change the game. But I don't have insider knowledge about what regulators will do. I don't know what conversations are happening behind closed doors at the CME, the Fed, the Treasury. I'm reading public information like you are and making educated guesses based on historical precedent. If you build a strategy, assuming certain regulatory actions won't happen and then they do, you can get destroyed. That's not my fault. That's the reality of trading regulated markets where rules can change quickly. You need to account for tail risks in sizing and risk management. You need exit plans. You need to know what you're willing to lose before you cut. That isn't investment advice. That's basic risk management for any speculative position in any market. One more thing. When I compare physical silver to paper claims, I'm expressing a preference based on my personal concerns about counterparty risk in a potential force majeure scenario. That doesn't mean physical is right for everyone. Physical has costs and risks, storage, insurance, premiums on the way in, discounts on the way out. Less liquidity compared to ETFs you can sell instantly during market hours. Whether those trade-offs make sense depends on your situation and priorities. If you value absolute certainty of ownership and you're willing to sacrifice convenience, physical can make sense. If you need speed, liquidity, or active trading, an ETF might fit better. Even with counterparty risk, there's no universal answer, only what's right for your circumstances. So, as we move into the part where I outline my personal battle plan, treat it like a case study. This is what one person with a specific set of assumptions and tolerances is doing. It could be inappropriate for you. Don't copy my plan. Don't mirror my triggers. Don't assume that because I'm holding through volatility, you should too. Build your own plan. Do your own research. Consult qualified professionals who can advise you based on your actual financial situation. This video is education and entertainment. It's market analysis and commentary. It's a deep dive into commodity mechanics during extreme stress. It is not a blueprint for your investment strategy. It is not a recommendation to buy, sell, or hold anything. Are we clear on that? Good. Because the last thing I want is someone risking money they can't afford to lose because they thought I told them what to do. I didn't. I'm showing you what I'm doing and explaining why. What you do with this information is entirely up to you. My personal move. Now, let me walk you through what I'm doing with my positions. Again, not advice. This is me sharing a personal plan built from 12 years in this market. Trigger 1, I'm watching the Shanghai gold exchange premium like a hawk. If that spread stays above $10 per ounce, I'm ignoring every dip on COMEX. It doesn't matter if silver pulls back to $95 or even $90. As long as there's a $10 arbitrage window, the physical drain is still happening. The correction is temporary. The structural shortage is persistent. If the Shanghai premium collapses, if it drops below $5, that's a different situation. That means the flow slowed. Maybe Eastern buyers are satisfied, or maybe the arbitrage closed through price convergence. At that point, I reassess. But as long as the premium stays wide, I hold. Trigger 2, I'm watching for a third margin hike this month. CME already raised margins on January 7th. If they raise again, if they double or triple requirements, I expect a forced liquidation event. Leverage longs get blown out. Price spikes down as traders scramble to meet margin calls. I'm not selling into that dip. I'm staying calm. I'm letting weak hands get shaken out. Then I'm watching whether physical demand returns, because margin hikes don't fix a shortage. They just decide who's allowed to participate. If I see that third hike and price drops 15% or 20% in a day, I'm not panicking. That's the exchange squeezing the paper market to protect shorts. The physical market reasserts within a week. Conditional action. If silver holds $100 through the weekly close through $500 p.m. Eastern on Friday, I'm moving my stop losses to 92ers. That gives me an 8% cushion to protect capital while staying in the trade. Why 92? Because it's below the psychological support at $100, but above the major level that was broken on the way up. If silver falls below $90 after holding $100, something changed. Maybe Shanghai premium collapsed. Maybe industrial demand cratered. Maybe a bailout or intervention hit the tape. At that point, I'd rather take an 8% loss and reassess than ride a full reversal. But if silver stays above $100 through the end of January, I'm not touching the position. The breakout is confirmed and the next target is $125, the nuclear option. If I see a force major declaration or cash settlement notice from the LBMA or COMEX, I pivot to 100% physical holdings immediately. In a broken system, I trust what I can touch. Paper claims are worthless if the exchange decides it doesn't have to honor them. If contracts are cash settled, that's confirmation the paper market is dead. At that point, I'm out of ETFs, out of futures, and into physical bars and coins only. I don't care about premium. I don't care about liquidity. I care about holding real metal that can't be rehypothecated or replaced with a digital entry on a ledger. That's my line in the sand. If the system admits it can't deliver, I stop playing the paper game. Here's what I'm not doing. I'm not chasing. I'm not FOMO buying at $100 because I'm scared it is going to $150 tomorrow. I built my position over years when silver was in the 30s and 40s. If you're getting in now, you need a plan that assumes volatility. I'm also not selling my core position. I don't care if silver hits $120 and then dumps back to $80. My thesis isn't the next 10% move. My thesis is a structural shortage that takes years to resolve. Final piece, I'm keeping 20% of my portfolio in cash. Not because I expect a crash, but because chaos creates opportunity. If forced liquidation hits, if margins spike and price drops 20% in a day, I want dry powder to add. The worst thing you can do in a volatile market is be fully invested with no ability to act. Cash gives optionality. It lets you be opportunistic instead of reactive. That's my plan, not advice. It's what I'm doing based on my risk tolerance, time horizon, and conviction that the physical silver market is in the early stages of a multi-year shortage. You need your own plan built around your own situation. But whatever you do, don't let the mainstream narrative convince you this is just a bubble about to pop. The return of honest pricing. Let me bring this full circle. We hit $100 per ounce. Shanghai is trading at a massive premium. Delivery notices are at record highs. COMEX vaults are being drained. Bullion banks are sitting on $390 billion of short liability with no clean way to cover. This is not a meme. This is not retail mania. This is not a bubble. This is the market repricing silver based on physical reality instead of paper derivatives. For 50 years, silver price was determined by how many contracts could be written on an exchange. Supply looked infinite because contracts were just digital entries in a ledger. You could short 1 million ounces you didn't own, and as long as you met margin, nobody cared. That game is over. The physical market is forcing its way back. The arbitrage between New York and Shanghai created an unstoppable flow of metal from west to east. And paper shorts are trapped in a position they can't unwind without blowing themselves up. This is what honest pricing looks like. It's violent, it's disruptive, it's uncomfortable for everyone who benefited from the old system. But it's also inevitable. You cannot suppress the price of a scarce asset forever. Eventually, physical reality wins. What we're watching is one of the largest wealth transfers in commodities markets in modern history. People who understood the physical shortage and positioned for it are going to do very well. Institutions that relied on paper leverage are going to get wiped out. The only question is how long authorities can delay what's coming. How many margin hikes can they push? How many rule changes can they roll out? How long can mainstream media keep the spotlight on volatility while ignoring delivery crisis? My guess, not much longer. The Shanghai premium is the canary in the coal mine. As long as that premium exists, the physical drain continues. And when COMEX finally runs out of metal to deliver, the paper price becomes irrelevant. At that point, silver trades at whatever price real buyers will pay. And based on what I'm seeing in Asia, that number is a lot higher than $100. Here's the final rallying cry. This isn't just about money. This isn't just about being right on a trade. This is about market integrity. This is about whether price discovery reflects real supply and demand, or how much leverage a bank can deploy. For decades, the answer was leverage. Banks controlled price through paper derivatives, and physical was an afterthought. Now the tables have turned. Physical is eating paper alive. And everyone who dismissed silver stackers as conspiracy theorists is starting to realize they weren't crazy. They were early. This is moving faster than the news cycle can process. By the time mainstream media fully catches up, the opportunity is gone. The metal is locked up, prices are multiples higher. If you want to understand how we got here, if you want the deep dive on the $390 billion to short position and the mechanics behind this mess, you need to go back and watch my previous breakdown. It covers the historical manipulation, CFTC data, lawsuits, and structural imbalances that made this inevitable. That video gives the full context for why this isn't just a short squeeze. It's the collapse of a 50-year pricing regime. Go watch that now. Understand the banker short. Understand what happens when margin calls actually hit. Because the $100 threshold we just crossed isn't the top. It's the beginning of the repricing.